At 94 years old, Warren Buffett revealed something that completely shattered the way I thought about retirement. Now here's the shocker. Since turning 70, he's only been buying 3 types of assets. And get this, none of them are the so-called safe bets Wall Street keeps pushing on you. Not the 60-40 portfolio, not target date funds, not the colorful pie charts your advisor loves to show off. Buffett tossed all of that aside. So why would one of the richest, smartest investors alive, someone who could buy literally anything, decide to only buy 3 specific things after age 70? The answer is so simple, yet so powerful, that once you hear it, you'll never look at retirement the same way again. Here's the thing. Buffett realized that after a certain point, money isn't just about chasing higher returns. It's about security, freedom, and making sure your wealth lasts, not just for you, but for the people you care about most. And that's exactly what we're going to break down in this video. I'll walk you through the 3 assets Buffett swore by after turning 70, why he picked them, and most importantly, how you can start applying the strategy to your own life, no matter your age or income. Before we jump into the first asset, let's pause for a second and ask, why should we even listen to Warren Buffett? This isn't just any investor. Buffett has lived through 15 recessions, multiple wars, oil shocks, the collapse of the dot-com bubble, the 2008 financial crisis, and more stock market crashes than most of us can count. And despite all that, he didn't just survive, he thrived. By the time he turned 70, his net worth was already north of $30 billion. At that point, he didn't need to make another dollar for the rest of his life. He had already won the game 100 times over. And yet, this is the surprising part. He completely shifted his investment approach. Why would someone at the top of the financial food chain, someone who could buy literally anything, suddenly simplify his portfolio down to just 3 types of assets? Because Buffett discovered something most investors only realize when it's too late. After a certain age, wealth stops being about growth and starts being about peace of mind. Think about it. In your 20s, 30s, and even 40s, you're chasing growth. You're taking risks, building your career, maybe even starting businesses. But when you hit your 60s and 70s, priorities shift. It's no longer about doubling your net worth. It's about making sure what you've built lasts. Buffett himself put it simply, what matters most is security, dignity, and legacy. Security, so you don't lie awake at night worrying about the next market crash. Dignity, so you can enjoy retirement without financial stress controlling your every decision. Legacy, so that the wealth you work so hard for outlives you and benefits the people you care about. Now here's the kicker. Most people never make that mental shift. They keep gambling on risky growth strategies, even when they can't afford to lose anymore. That's why so many retirees end up anxious, broke, or depend on others. Buffett refused to fall into that trap. He simplified everything down to 3 key assets that gave him stability, income, and long-term resilience. So what were they? Let's dive into asset number 1. And trust me, it's not what most retirement planners would tell you. Asset number 1, cash-generating monopolies. When most people think of Warren Buffett, they imagine him glued to a stock ticker, buying and selling shares like some Wall Street wizard. But here's the truth. Especially after he turned 70, Buffett wasn't just buying stocks anymore. He started buying entire businesses. And not just any businesses. He went after cash-generating monopolies. In other words, companies that dominate their industries, sell things people cannot live without, and produce steady cash flow whether the economy is booming or crashing. Let me give you a prime example, BNSF Railway. In 2010, Buffett spent a jaw-dropping $26.5 billion to buy the company outright. At the time, critics laughed. Who still invests in trains in the 21st century? But Buffett wasn't chasing flashy headlines. He was buying reliability. Nearly half of America's freight, everything from food to fuel to raw materials, moves by rail. And here's the key. Those trains don't stop. Not for recessions, not for inflation, not for stock market crashes. Which means BNSF delivers what Buffett loves most. Steady, predictable cash. Another big move? Berkshire Hathaway Energy. Think about it. No matter what happens in the economy, the lights have to stay on. People pay their power bills in good times and in bad. And when millions of households are your customers, you're sitting on a river of reliable income. Now, you might be thinking, okay, that's great for Buffett, but I'm not buying railroads or power plants anytime soon. Fair point. But here's the beauty of Buffett's principle. You can apply it at any level. I'll share a story. A retired engineer I met in Detroit didn't put all his savings into mutual funds or chase hot tech stocks. Instead, he bought a modest apartment building in a working-class neighborhood. It wasn't glamorous. Nobody was writing articles about him in Forbes. But every single month, that building paid him around $3,200 in rental income. Boom or bust. That money kept rolling in. That's the exact same principle Buffett used. Cash flow over speculation. And here's how you can apply it to your own life without billions in the bank. 1. Dividend aristocrats. These are companies that have paid and increased their dividends for 25-plus years straight. Think Coca-Cola, Johnson & Johnson, or Procter & Gamble. These aren't sexy stocks, but they quietly pay you whether markets are up or down. 2. REITs. Real estate investment trusts that own things like hospitals, warehouses, or even data centers. They pool investor money and pay out regular dividends. You get the benefits of real estate without the headaches of fixing leaky toilets. 3. Small, everyday businesses. Think laundromats, car washes, or even a vending machine route. These businesses don't care about the S&P 500. They make money because people need them daily. Now here's the ultimate question to ask yourself, and it's the same one Buffett asked after 70. Will this asset pay me reliably when I can no longer work? If the answer is yes, you're on the right track. If not, then you're still speculating, and speculation is the last thing you want to depend on in retirement. Buffett didn't care about hype. He cared about income that never stops. And that's what asset number 1 is all about. Finding your own version of a cash-generating monopoly. Asset number 2, government-backed float. Now, let's move on to the second asset Buffett leaned on after 70. This one might sound boring at first, but once you understand it, you'll realize it's absolutely brilliant. Buffett calls it float. Here's how it works. Through his insurance companies like Geico, millions of customers pay their insurance premiums up front. That money comes in today. But Buffett doesn't have to pay claims until sometime in the future, sometimes years down the road. Now, here's the genius part. In the meantime, Buffett gets to invest that money. Think of it this way. Someone hands you billions of dollars at 0% interest, lets you use it for as long as you want, and you get to keep all the growth it generates before you eventually give it back. That's float. It's not flashy like owning Apple stock or building railroads. But Buffett has called float one of the most powerful tools behind Berkshire Hathaway's success. Now I can almost hear you saying, well, that's nice for Buffett, but I don't own an insurance empire. So how does this apply to me? Here's the takeaway. You don't need billions in insurance premiums to use this principle. What you can do is focus on safe, guaranteed returns instead of swinging for the fences with risky bets. Let me give you a few examples that work for everyday people. 1. Treasury I-bonds. These are government-backed savings bonds that adjust with inflation. Right now, they're paying north of 5%. No stock market risk, no sleepless nights, just steady inflation-protected growth. 2. CD ladders. Think of these as staggered bank deposits. You spread your money across certificates of deposit with different maturity dates. Some 6 months, some 12 months, some 2 years. The result? A predictable flow of money coming back to you on schedule while still earning interest. 3. Fixed annuities. This is where you give an insurance company a lump sum, and in return, they guarantee you a set monthly income for life. It's not exciting, but it's consistent. Let me bring this down to a real-life story. A retired teacher I know had about $200,000 saved. Instead of chasing stocks or crypto, she rolled it into a fixed annuity. Today, she collects about $1,100 every single month. It's not a lottery win. She's not buying yachts. But you know what? She never worries about running out of money. That peace of mind is priceless. And that's really the lesson here. When you're in your 50s, 60s, or 70s, you don't need financial home runs anymore. You need base hits you can count on. Reliable, boring, government-backed returns are what help you sleep at night. So let me ask you, which one appeals to you more? Steady rental-style cash flow, like we discussed in asset number 1, or guaranteed government-backed returns like float? Drop your answer in the comments. I'd love to see which side you're on. Asset number 3, reputation capital. All right, now let's talk about the third asset Buffett leaned on after 70. And this one might surprise you, because it's not money, it's not stocks, it's not even real estate. It's something you can't buy with cash, but it's arguably more valuable than any investment in the world. Reputation capital. Think about it. When a company hits a crisis, who do they call first? Warren Buffett. When the markets melt down and investors everywhere are panicking, whose calm words get quoted across every financial news network? Buffett. That level of trust didn't just come from his billions. It came from decades of showing up, doing what he said he'd do, and delivering results. And here's the key. Reputation compounds faster than money. Let me explain. I know a financial advisor in Phoenix who started writing a tiny weekly newsletter. Just a few paragraphs of practical financial advice for local business owners. Nothing flashy. No sales pitch. Just helpful content. At first, only a handful of people read it, but he stuck with it. Over 15 years, that newsletter grew to more than 8,000 subscribers. Now, he doesn't chase clients. They chase him. His reputation does the marketing for him. But here's the part one want you to hear clearly. This isn't just about business. It applies to you, too. Maybe you're an engineer mentoring the younger staff at your company. Maybe you're a nurse who shares health tips with your community. Maybe you're a carpenter or mechanic teaching others your craft. Every piece of wisdom you share, every act of consistency, every promise you keep is building your reputation account. And here's the beautiful thing. That reputation can eventually turn into opportunities money can't buy. Maybe it leads to consulting gigs after retirement. Maybe it's a side income stream you never expected. Maybe it's simply the fact that when your name comes up, people say, "Oh yeah, I trust them." Wealth can get you into the room. But reputation? Reputation keeps you there. And often, it opens doors to even bigger rooms you never dreamed you'd enter. Let me give you an everyday example. A retired police sergeant I know didn't just hang up his badge when he left the force. He took his decades of experience and started consulting small businesses on security protocols. He charges $150 an hour, and he's booked solid. Why? Because people trust him. His reputation became his retirement plan. And here's why Buffett leaned into this after 70. Money, no matter how much you have, can be lost in a bad market or devalued by inflation. But reputation, once you've built it, it can generate opportunities, trust, and income for the rest of your life. So here's my question for you. What's one area of your life or work where you could start building reputation capital today? Maybe it's sharing your expertise online. Maybe it's mentoring someone at work. Maybe it's documenting the lessons you've learned. Drop your answer in the comments. I'd love to hear how you're thinking about building your own Buffett moat. The deeper wisdom. Let's step back for a moment. Why do these three assets, cash-generating monopolies, government-backed float, and reputation capital, really matter? Because after a certain age, the scarcest resource isn't money. It's time. When you're in your 20s or 30s, you can take wild risks with your money. You buy speculative stocks, try side hustles that might flop, even lose a chunk of savings, because you've got years, even decades, to bounce back. But once you're 60, 70, or beyond, every dollar takes on a new meaning. It's not just a number in your portfolio anymore. It's the ability to pay for your health care without stress. It's the freedom to spoil your grandchildren. It's the dignity of living life on your terms, not out of fear. And that's exactly what Buffett figured out after 70. Look at the assets he leaned on. 1, railroads and utilities that will keep running long after he's gone, generating steady cash for decades. 2, insurance float that protects families while giving him guaranteed growth. 3, a reputation so strong that his wisdom will guide investors for generations. This isn't retirement planning in the traditional sense. This is dynasty thinking. It's not about how much money can I make before I die. It's about how do I structure my wealth so it continues to create security, opportunity, and impact even after I'm gone? And here's the thing. You don't need Buffett's billions to live by these principles. Let me give you a personal story. My grandfather never owned a single stock. He wasn't a billionaire. He was a steel mill worker who saved what little he could. But he made 3 smart choices that mirrored Buffett's playbook. 1, he bought a simple duplex. He lived on one side, rented out the other. That rent check came in every month, recession or not. 2, he put money into government bonds. Safe, boring, predictable income. 3, and maybe most importantly, he built a reputation in his community as a man of his word. People trusted him. When he passed, that reputation still opened doors for his kids and grandkids. When my grandmother was widowed, the duplex income kept her bills paid. The bonds gave her steady support. And the goodwill he left behind meant his family had opportunities they might never have had otherwise. He didn't leave behind billions, but he left behind something even more valuable: security, dignity, and a legacy. That's the deeper wisdom of Buffett's post-70 strategy. It's not about chasing the next hot stock or obsessing over beating the market. It's about aligning your money with what really matters: peace of mind, freedom of choice, and building something that lasts beyond your lifetime. Practical application. All right, let's bring this down to earth. It's one thing to hear how Buffett does it with billions, but how do you apply these same principles in your own financial life? Let's break it down into 3 parts. 1, build your own cash flow monopoly. Buffett loves owning businesses that spit out money like clockwork. You can do the same on a smaller scale. 1, start with dividend-paying stocks. Look for dividend aristocrats, companies that have paid and increased dividends for decades. Think Coca-Cola, Johnson & Johnson, or Procter & Gamble. These aren't glamorous, but they're like that reliable friend who always shows up. Every quarter, they pay you just for owning them. 2, explore REITs, real estate investment trusts. Maybe you don't have the cash or the patience to manage tenants and leaky roofs. REITs let you invest in hospitals, warehouses, and apartments without owning the property yourself. It's a hands-off way to earn steady income. 3, consider small local assets. I know someone who bought a coin-operated laundromat. It's not flashy, but every week those machines come along and produce cash. Others buy small duplexes or single-family rentals. Live in one, rent the other. That one decision can cover your mortgage and build long-term wealth. The takeaway? Don't wait until you can afford a giant railroad. Start with mini monopolies that generate predictable income. 2, secure government-backed income. The older you get, the more you want money you don't have to worry about. 1, I-bonds. These are savings bonds from the U.S. Treasury that adjust with inflation. If prices rise, so does your interest. For someone worried about their retirement money losing value, this is a simple and powerful option. 2, CD or Treasury bill ladders. Instead of locking up all your money for years, spread it across different maturities. For example, put $5,000 into a 6-month CD, another $5,000 into a 1-year, and another into a 2-year. Every few months, one matures, and you can reinvest. This creates steady, rolling income. 3, fixed annuities. Imagine you worked hard, saved $200,000, and now you're retired. You could put that into a fixed annuity and guarantee yourself $1,000 to $1,200 every month for life. It may not sound exciting, but that check will arrive whether the stock market is booming or crashing. Peace of mind is priceless. Remember, at 25, you might swing for the fences. At 65, it's all about safe, reliable base hits. 3, grow your reputation capital. This one is invisible, but it might be the most powerful of all. 1, share your expertise. Maybe you're an accountant who can explain tax tips in plain English, or a teacher who shares simple learning hacks online. Content builds trust, and trust builds opportunities. 2, mentor in your community. I know a retired engineer who volunteers at a local trade school mentoring young people. Now, those same students are grown professionals who bring him consulting projects. His reputation became his retirement income. 3, be consistent. Buffett didn't become the Oracle of Omaha overnight. He built his reputation brick by brick, year after year. You can do the same by showing up, being reliable, and letting your integrity speak for you. Opportunities will eventually start finding you. And here's the best part. You don't need billions to start building these assets. You don't even need hundreds of thousands. All you need is to take one step, buy one dividend stock, open one treasury bond account, write one blog post, or mentor one person. Wealth isn't built in giant leaps. It's built in small, steady moves that stack up over time. So let's take a step back. At 94 years old, Warren Buffett, one of the wealthiest, most respected investors alive, showed us that real wealth after 70 isn't about chasing flashy stocks, timing the market, or gambling with risky bets. It comes down to just 3 assets. 1. Cash flow monopolies that pay you whether the economy is thriving or struggling. 2. Government-backed security that guarantees peace of mind, not sleepless nights. 3. Reputation capital that outlives you and opens doors money can't. Here's the deeper truth. You don't need billions to follow this blueprint. You just need to start. Buy that first dividend stock. Put a little into I-bonds or CDs. Share your knowledge, mentor someone, or build your name in your field. Each small step is like planting a seed. And one day, you'll look back and realize you've grown your own version of Buffett's empire, built on security, dignity, and legacy. Now, I want to hear from you. Which of these 3 assets would you start building today? Cash flow, government security, or reputation? Drop your answer in the comments. I read every single one. And if you found this video helpful, give a thumbs up. It helps more people discover these wealth-building ideas. Subscribe if you haven't already. Because here at Wealth Quench, we break down money wisdom in a way that's practical, relatable, and actually doable. Remember, wealth isn't just about money in the bank. It's about freedom, peace of mind, and the legacy you leave behind. And that's something you can start building right now. Thanks for watching, and I'll see you in the next video.